Hello, everybody. Welcome back to another episode of the Dividend Payout channel. Thank you guys for tuning in. Before we get started, can you please hit that subscribe button, that like button, and comment down below? I'd really appreciate it. I'm not a financial advisor. Uh, I'm just showing you guys what has worked for me and what I've done to build a $0 portfolio into a $218,000 portfolio. So let's move on how I did it. This is what I followed. I'll go over a breakdown of the cumulative return my portfolio is currently having. But right now, we'll go through what you need to do to have the success that I just did. So do whatever it takes. The first step you need, do whatever it takes to save the first 100,000. Why the first 100,000 matters most. You can save 100,000 in as little as 5 years with consistency and patience. Patience being the number one, and consistency. So the common mantra on wealth building blogs and investor forums is that the first 100,000 is the hardest to save. And well, yes, it is, but it's not impossible. I know 100,000 is a lot of money, and it is, but we'll go over why after 100,000 it gets much easier. So long as you're willing to crunch the numbers and make some sacrifices, guys. Sacrifices for the first 100,000, you got to do it. I mean, if it's one less cup of coffee from Starbucks, so you can put that into your investment account every week, it's worth it. Down the road, it'll be worth it. Warren Buffett and Charlie Munger have also claimed that the first $100,000 is a beat. That's Charlie's words, not mine. You can go look it up. But once you get there, it gets easier. And why is that? You guys comment down below. Why do you think it gets easier after 100,000? And I'll tell you why right now. Compounded interest. Compounded interest. If you keep your money invested, it will grow at an increasing rate. Eventually, the interest you receive might even outpace your contributions. However, before that can happen, you must get past the financial and physical or psychological obstacles standing in your way. How compounded interest works. So, from my personal experience, the majority of my first $100,000 savings was invested in the stock market. Six figures is where compounded interest begins to have a meaningful impact. When you start your savings journey, it's like pushing a boulder uphill. Since you don't have enough saved to generate a significant investment return, you have to save nearly every penny to cross that 100,000 threshold. They also use the analogy of the snowball effect. It starts out small, and as you roll it up, it's hard and harder. Once you get over that hill, you can roll it down the hill, and that snowball will get bigger and bigger. It's kind of like the boulder. Hard to push it up the hill. That's the first 100,000. Once you get over that hill, compounded interest just kind of works itself, and it's much easier. But compound interest is when the interest you earn on a balance in a savings or investment account is reinvested, earning you more interest. Here's a quote that I like. As a wise man once said, money makes money, and the money that money makes money. Time also helps. The longer you have for compounded interest to work, the greater your returns will be. It's generally easier because your first 100,000 is now earning you an investment return. If you get a 7% return on your investment, it means you will double your $100,000 in 10 years without even contributing anything, not even a penny. But you can cut down that significantly 10-year time frame by contributing regularly. So if once you get to 100,000 and you're earning 7% and you're contributing regularly, you can get to the next 100,000, so 200,000 in a way shorter amount of period. So moving on, what holds a lot of people back from investing is fear of losing money. Investing can be scary, especially if you're new to it. The stock market can be volatile, um, which prices fluctuate every day, which can cause your investments to drop in value, but they can also go up in value. This can make you feel like gambling, which can lead some people to keep their money in a checking or savings account where the money just it's there unless you spend it. But this means you are effectively losing money over time thanks to inflation. If inflation rates at 3%, you have your money in just a savings, which everybody's going to want to have a little bit of checking and savings. You still have to pay bills and live your life day to day. But if inflation's at 3%, you're effectively losing 3% value of buying power. But if you're earning 7%, you're negating the inflation. So get over that fear. To get past this fear, it helps to zoom out and look at the long term. While the stock market can drop for weeks, months, or even years, it has always rebounded. Take the Dow Jones 100-year historical chart, for example. In this chart, I'll show you on the next slide, we can see that the Dow has increased by about 20 times in the past 100 years, and this includes the Great Depression, the 2008 financial crisis, and various other recessions. Investing is not a get-rich-quick scheme. To succeed with investing, you must stick with your strategy for the long term. Over the years and decades, the committed investor will see their money grow. As I always refer back to Warren Buffett, you guys, if you're not familiar with him, look him up. He's a committed investor, and he's like the 5th richest person in the world. So be a committed investor. And also to get over that fear is invest in companies that have long-term outlook. Here's that chart I was talking about, the Dow Jones historical. So you can see here's 1950, some drops, and 2000 and where we are currently. So these big drops, I don't have it marked on here, but 1930, the Great Depression, you can see how it went clear down. That was probably the Great Depression. A loss on paper isn't a loss in real life. So if your portfolio or your stock drops significantly and you're panicking, like, oh, I lost $10,000, you haven't really lost the $10,000 unless you sell it. That makes it real. If you hold it, see if you lost money on paper but held it back. Say you had a stock here, panicked and sold it, but you bought up here, you're permanently in the loss. But if you know this is a good company, I'm going to keep this company, it's going to make me money, I'm going to hold it through the bad times and the good times. You can see if you bought it here and you held it till here, you're very happy you didn't sell. So here's 1950. You can see gradual up and downs. You can see the valleys. That's just how the stock market works. Here's another big crisis. I'm not sure what year that was, 1970-ish. And then here we have the 2008 financial crisis right here. You see a dip. But if the market will rebound if history is an indicator, as I just showed you. Let's go over some numbers. Here's when you'll hit realistically. You guys got to be realistic. Obviously, the more money you contribute, the faster you'll hit this number. But not everybody's in the same situation. I certainly wasn't. I started from nothing, and it took me a few years to get my portfolio to 218,000. But I can tell you guys, once you get to the 100,000, you'll see every time it's like I log in, I feel like it goes up and up and up. So it took me a really long time. I was almost discouraged. That's why I'm making the video. For the people who don't have anything, starting now is better than not starting at all or being discouraged. So if you break it down, here's if you invest $200 a month, which anybody should be able to scrounge. I know sometimes money can be tight, but sacrifice somewhere to get something going. So if you invest $200 a month, earn a 6% return, you'll have 100,000 in a little over 20 years. But if you're earning an 8%, which this is typically where you'll want to be, that 8 to 10% return. You'll have it in 18 years. If you can invest more and go to $500 a year, which is 120 over $100 a week, and you're earning 6%, it'll take you 11 years. But if you're earning around the 8%, which can be about the average, it'll take you about 10 and a half years. And then you can see if you increase your contributions, you'll get there faster. But this first 100,000 takes the longest. It's going to take significantly longer. Even if you contribute, so say you contribute 500 and you're getting an 8% return, it takes you 10 and a half years. If you continue to contribute the 500, the next 100,000 to get to 200 is going to be significantly less because you're earning interest on that 100,000. This is what my portfolio is currently returning. Here's a little snapshot of my cumulative return from November 7th, 2023 till March 27th, so just a few days ago. I had a cumulative return of over almost 40%, 39% there. So my portfolio currently consists of 28 individual stocks, all of which pay a dividend. Guys, I'm not much of a growth. I'm not knocking them, but just for me, I look at the company, blue chip stock companies that pay a dividend that have a long-term outcome, positive outcome. I also have 2 ETFs, both Vanguards, the S&P 500 VOO and Vanguard VDC. This is the strategy I use when an individual stock is down. That's when I buy more. And when I get paid, every time I get paid from my job, I allocate a certain percentage and contribute no matter what on schedule. So, and sometimes I'll put money in and it'll sit there because I feel like the stock price is kind of high, and I will wait. So patience is key. Yeah. So wrapping up, guys, do your own research before you invest. Never give any money to anybody that calls claiming to be a financial advisor. Just be smart. You guys worked hard for your money. When in doubt, reach out to a reputable financial advisor. Do your research before just do your research and contribute and be consistent. That's basically what got me to where I am right now. So with my $218,000 portfolio. So thank you guys for watching. I really do appreciate it. I hope that helps some of you. Please hit that subscribe button and like button. I really appreciate it. Please hit that subscribe button. Thank you. See you guys on the next one.